You paid $3,847 in home insurance last year? Not because your house was at risk, not because you filed a claim, not because anything happened at all, just because someone told you that you had to. The family I sat with last month in Holmes County, Ohio, has never paid a single dollar in home insurance. Not last year, not in any year, 6 generations in the same community. 0 premiums, 0 deductibles, 0 adjusters, and when their neighbor's barn burned down last spring, it was rebuilt in 4 days. No claim filed, no adjuster dispatched. No 6 months of waiting for an answer that might be no. Just neighbors, tools, and 4 days. Today, I am going to show you the exact system Amish communities have used for over 200 years to protect their homes without ever writing a check to an insurance company. Not theory, not philosophy, the actual structure, the actual numbers, and the actual reason why this system was quietly dismantled for the rest of America while no one was paying attention. And at the end of this video, I am going to share the exact year, the exact law, and the exact industry that took apart the system. Your grandparents used a system that covered 50% of all American adults before 1920, and that was gone within 40 years. That research changed the way I think about everything I pay for. I think it will change yours too. Let me start with the money, because the money is where this story gets personal fast. The average new home insurance policy in America right now costs $1,950 a year. That is the national average. If you happen to live in Nebraska, Louisiana, Florida, Oklahoma, or Kansas, your average jumps to over $4,400 a year. And most people do not realize these numbers are not stable. They are accelerating. Since 2019, home insurance premiums across the country have climbed 64%. In 2024 alone, they jumped 17.4% in a single year. That was the largest annual increase in decades. If you bought your home in 2021 and you are reading your latest renewal letter right now, you are paying roughly 69% more than you paid just 3 years ago for the exact same house, on the exact same street, with the exact same risk profile. Nothing changed except the number on the bill. Now think about what that means for your monthly budget. Home insurance now represents 9% of the average monthly mortgage payment in the United States. That is the highest percentage ever recorded in the history of American homeownership, and 6 million American homeowners have simply stopped carrying insurance altogether, not because they are reckless, not because they do not understand risk, because they literally cannot afford the premiums anymore. 6 million families exposed, not by choice, but by a system that priced them out. And here is the question you should be asking: where is all that money going? The property and casualty insurance industry reported $166.8 billion in profits in 2024. Let that number settle for a moment. That is a 91% increase over 2023, a 330% increase over 2022, their 23rd consecutive year of profitability. Every single year for nearly a quarter century, this industry has made money. Not broken even, not survived, profited, while raising your premiums every single year and telling you it was because of rising risk. But here is what they are not putting on those renewal letters. A 2024 study by Weiss Ratings found that 14 of the largest insurance companies in America closed between 40 and 51% of all homeowner claims without paying a single dollar. Not a partial payment, not a negotiated settlement, nothing. In Florida, which charges some of the highest premiums in the country, 46.7% of weather-related claims were flat out denied. That is a record denial rate. Almost half. You are paying record premiums for a product that has a coin flip chance of actually paying you back when you need it most. If that number stopped you cold, hit the like button right now, because what I am about to tell you next is how they keep this machine running. Those same insurance companies took the premiums you paid, your money, and invested between $536 and $582 billion of it into fossil fuel assets, coal, oil, and natural gas. They are pouring capital into the industries that are accelerating the climate disasters that they then refuse to cover when those disasters hit your house. Let me say that one more time so it really lands. They collect your money, they invest it in the things making your home less safe, and when the storm arrives, they deny your claim. That is not a broken system. That is a system working precisely as it was designed to work, just not for you. And if you think the companies are at least sticking around to honor the policies they sold, think again. In 2023, State Farm and Allstate abandoned the California market entirely, pulled out, stopped writing new policies, but they kept collecting premiums from existing customers right up until the very last possible day. In Florida, insurance companies reported financial losses to state regulators while simultaneously sending $680 million in dividends to their shareholders. The Tampa Bay Times and the Miami Herald both documented this. They told regulators they were losing money. They told investors they were making money. Both cannot be true, but both went unchallenged. And who is supposed to be holding them accountable? State insurance regulators. Except, in 2022, state governments collected $32.7 billion from the insurance industry, and only 5.34% of that money went toward actual regulatory activity. The rest disappeared into general government funds. The regulators are funded by the companies they are supposed to regulate, and when those regulators leave government service, they walk straight through the revolving door. The insurance commissioner of Florida, David Altmaier, resigned from his regulatory position and immediately joined the largest insurance lobbying group in the state. Ralph Nader documented this revolving door pattern years ago, and it has only accelerated since. The people writing the rules and the people profiting from those rules are often the same people at different points in their career. So what is the alternative? What do you do when the entire system is rigged from the inside? You look at the people who never joined it in the first place. When I first started spending time with Amish families in Lancaster County, Pennsylvania, I will be honest with you, I was skeptical. I kept waiting for the catch. I thought mutual aid sounded like a nice idea in theory, a community helping each other, very heartwarming. But I wanted to know what happens when something actually goes catastrophically wrong. What happens when a real disaster hits a real family and real money is needed immediately? Then I watched it happen firsthand. A house fire in Holmes County, the kind of devastating event that would send any normal American family spiraling into months of phone calls, mountains of paperwork, waiting periods, appeals, and maybe, if they were lucky, a partial payout 9 months later. Do you know what happened instead? Before the firefighters had even left the scene, people started showing up, dozens of them. One Amish man told me that before the firefighters had left, there were people all over. Within a week, the structure was going back up. 12 sawmills across the surrounding area cut lumber specifically for that rebuild. The joints were mortise and tenon. The fasteners were wooden pegs, not nails. This was not some hastily assembled emergency shelter meant to last a few years. This was construction designed and built to stand for 200 years. Craftsmanship that most modern contractors could not match with any budget. The wives organized meals for every worker every day. They brought quilts for the displaced family. Children helped carry materials and tools. The whole event was as much a social gathering as a construction project. People reconnected, bonds strengthened, and when the building was finished, the family who lost their home owed absolutely nothing. No debt, no premium increase, no claim on a permanent record following them for 7 years, nothing. One Amish man I spoke with described the hardest part of the whole experience, and it was not losing the building. He said the hardest part is accepting the help coming in, they can never pay it back, and the people helping do not want them to pay it back. That sentence changed something deep in me, because in the system you and I live under, everything is a transaction. You pay a premium every month for years, then something happens and you file a claim. Then a person in an office you will never see decides whether your loss qualifies under terms you barely understood when you signed, and nearly half the time, that person decides it does not qualify. In the Amish system, help is not a transaction. It is a relationship built across decades. Someone described it to me as a mix between socialism and capitalism with hard work at the center. I have never heard a better description of something that actually works. Let me explain how this system operates day to day, because it is not chaotic or spontaneous. It is highly organized. When a need arises, the word goes out during Sunday church services. The community organizes itself with remarkable efficiency. People arrive before sunrise, often by 4:45 in the morning. They bring their own tools, their own lumber, their own specialized skills, and enough food to feed an army. A full barn raising can involve dozens or even hundreds of people working in coordinated teams. The primary structure of a large barn can be erected in a single day, and the entire system runs on one foundational principle that the commercial insurance industry abandoned generations ago. Today I help you, tomorrow you help me. No contract required, no middleman extracting a profit, no shareholder expecting a quarterly return on someone else's misfortune. For larger ongoing needs like medical expenses and major emergencies, the Amish communities in Holmes County maintain a formal mutual aid fund. Members contribute between $90 and $110 a month. Compare that to the $300 to $600 monthly premium for a commercial health insurance policy. The fund administrator negotiates directly with hospitals and medical providers, and he consistently secures better pricing because he pays in full, in cash, within 10 days. There is no paperwork backlog, no pre-authorization dance, no 3-month waiting period while someone reviews your file. For truly exceptional expenses that exceed what the fund can cover, the church deacon personally visits every family in the district to request a special contribution. The money materializes. It always materializes, because the system is built on trust that has been earned over centuries. Here is a detail that genuinely stunned me when I first confirmed it was real. When Amish families borrow money from banks, those banks do not require commercial insurance on the property as collateral protection. Instead, they accept a letter from the local bishop. That letter serves as a written guarantee that the church community will rebuild or replace any loss. This is not folklore. This is not a story passed around campfires. This is a documented practice found in real banking compliance records. Licensed bankers accept the bishop's letter because the community standing behind it has never once failed to deliver on its promise. Not once. In over 200 years. Now, if you already own a house and you are thinking this is only for people building from scratch or living in a religious community, stay with me. Because this next part is specifically for you. You do not need to be Amish. You do not need to move to Holmes County. You can start applying principles from this system to protect yourself and your home right now, this weekend. The first and most practical step is something I learned from a retired carpenter in Lancaster County who had spent 40 years working on both Amish and non-Amish properties. He told me that the single biggest reason insurance claims get denied on existing homes, especially older ones, is deferred maintenance that the homeowner never documented. His solution was brutally simple. Walk your entire property once every season. Take clear photographs of your roof, your foundation, your gutters, your window frames, your siding, every exterior surface that matters. Date those photographs carefully. And store them somewhere that is not just your phone. A printed binder kept in a fireproof box. A cloud backup with a second copy on a thumb drive. Redundancy matters here. When you accumulate 3 or 4 years of dated, seasonal photographs showing consistent maintenance, 2 powerful things happen. First, you become dramatically less likely to experience the kind of gradual deterioration that insurance companies are trained to classify as owner neglect rather than covered damage. That classification is how they deny claims. If you can prove you maintained the property, that classification becomes much harder for them to apply. Second, and this is the part that saves real money, if you do file a claim after a storm or an incident, you now possess an undeniable visual timeline proving the condition of your home before the damage occurred. That carpenter told me this single habit has saved homeowners he personally knows tens of thousands of dollars. Not by replacing insurance, by forcing the insurance you are already paying for to actually function when you need it. For those of you with homes built before 1980, this matters even more. Older homes contain materials and construction methods that modern insurance adjusters often do not understand or properly value. Real plaster walls, balloon framing, original growth hardwood flooring, Hand-laid tile. These materials cost far more to repair or replicate than the generic estimates a claims adjuster will pull from a software database. Your seasonal documentation is your proof. It is your leverage. And it costs nothing but one afternoon 4 times a year. Beyond documentation, the deeper lesson from the Amish applies to everyone regardless of where you live. Know your neighbors. Build real relationships on your street and in your community. I know that sounds simplistic, but consider this. The Amish mutual aid system works because the people within it have deep personal connections cultivated over years and decades. They know who is a carpenter. They know who owns a chainsaw. They know who can cook for 30 people on short notice. That knowledge is itself a form of insurance that no company can sell you. You do not need a formal mutual aid charter to start building that. When a storm knocks a tree onto your neighbor's fence, do not wait for their insurance adjuster to show up in 3 weeks. Grab a chainsaw, call 2 other neighbors, and handle it on a Saturday morning. That single act saves thousands of dollars in claims and contractor fees. More importantly, it builds the kind of trust and reciprocity that no insurance policy in the world can replicate. And the next time something hits your property, those same neighbors remember what you did for them. Now I need to tell you the part of this story that genuinely made me angry. Because the Amish system is not some quirky cultural relic. It is the last surviving example of a system that nearly every American family had access to just 100 years ago, and it was deliberately destroyed. In 1910, approximately 1/3 of all adult men in the United States belonged to a mutual aid society. These were called fraternal lodges. They were not charities. They were structured organizations built on the identical principle the Amish still use, reciprocity. You paid a small monthly amount, somewhere between 25 and 35 cents, and in return you had access to life insurance, medical coverage, home protection, elder care, orphan support, and even college scholarships for the next generation. By 1920, fully half of the adult population of the United States had meaningful coverage through one of these mutual aid organizations. Not through government programs, not through commercial insurance corporations, through neighbors helping neighbors, formalized and funded. And then the dismantling began. Here is the timeline that no one puts together for you. In the 1910s, the American Medical Association launched an organized campaign against any mutual aid society that hired its own physicians. The AMA revoked medical licenses from doctors who accepted contracts with these organizations, not because the care was poor, because the care was too affordable. Affordable care threatened the pricing monopoly the AMA was building for its members. In the 1920s, major commercial insurance companies began lobbying state legislatures to impose minimum capital reserve requirements on any organization that offered insurance products. These minimum thresholds were calibrated to levels that only large, well-capitalized corporations could satisfy. The mutual aid societies, which operated successfully on community trust and small regular contributions, could not meet these artificial requirements. They were regulated into extinction. Not because they had failed, because they had succeeded too well at too low a cost. In 1935, the Social Security Act positioned the federal government as the primary provider of safety net services, further marginalizing the private mutual aid organizations that had been filling that role effectively and affordably for decades. The message was clear. The government would take care of you now. You did not need your neighbors anymore. And conveniently, the commercial insurance industry would handle everything the government did not cover for a fee. Of course, a fee that would grow every single year. By the 1940s, the big commercial insurers, the federal government, and the AMA had formed an effective alliance that challenged mutual aid at every regulatory and legislative level. Hospital accreditation rules in the 1960s and 1970s required facility upgrades so expensive that the fraternal hospitals run by these societies simply could not survive. They shuttered, and in less than 40 years, a system that had protected half the country vanished almost completely. David Beto, a historian, wrote a book published by the University of North Carolina Press titled From Mutual Aid to the Welfare State. He meticulously documented how the major insurance companies and the AMA worked in concert with government regulators to challenge and limit the friendly societies at every turn. This is not a conspiracy theory whispered in dark corners of the internet. This is documented, peer-reviewed history published by one of the most respected academic presses in the United States. The complete system I have been describing, how the Amish handle energy, water, fuel, heat, and now community protection, is laid out in the Amish Home System Guide. The link is in the description if you want the full picture. The Amish never joined the replacement system. They received an explicit religious exemption from the Social Security Act. They remain the only community in America with a documented legal exemption from mandatory commercial insurance participation, and the reason is straightforward. They did not need an external safety net because their internal one had never broken. Their barns from the 1850s are still standing, not because the wood is special, because the community that cares for those structures never stops showing up. And here is the lock that keeps you inside the current system. If you carry a mortgage today, your lender contract requires you to maintain home insurance, Fannie Mae and Freddie Mac, which back approximately 70% of all American mortgages, mandate insurance as a non-negotiable condition. The federal government effectively requires you to purchase commercial home insurance if you finance your home, and the mutual aid alternative that once served half the country has been regulated into a position where it cannot meet modern state capital requirements. It cannot legally function as a substitute. They did not just bury the old system, they made the alternative structurally impossible for anyone with a mortgage. The Amish bypass this entirely because they purchase their properties with cash. No mortgage means no lender mandate. Their community guarantee, backed by the bishop's letter, satisfies the institutions that interact with them. They exist in a parallel financial structure that the rest of us have been permanently locked out of. Not because their approach failed, because the entities profiting from the current arrangement spent a century ensuring we could never return to what worked before. 1 in 3 American homeowners says they would cancel their home insurance tomorrow if given the choice. They cannot, because the mortgage demands it. Because the system was built specifically so that you would have no alternative. The average Amish family in Holmes County contributes about $100 a month to their mutual aid fund. That single contribution covers medical care, property protection, and emergency community response. The average American household pays nearly $2,000 a year on home insurance alone, plus $6,000 or more on health insurance, plus property taxes, funding public services the Amish manage internally. The financial gap is enormous, and the performance gap is even wider. The Amish mutual aid system has not failed a single member in over 2 centuries. The commercial insurance industry denied nearly half the claims it received last year, while posting the largest profits in its history. We did not lose the mutual aid system because it was old-fashioned or impractical. We lost it because it was too effective. It eliminated the need for corporate middlemen. It erased profit margins from human vulnerability, and the organizations that depend on extracting those margins spent 100 years making certain we could never rebuild what they dismantled. Think about that. A system that served half the country, that cost pennies on the dollar compared to what we pay now, that never denied a claim, that never posted a quarterly earnings report, was systematically destroyed, not by market competition, by regulatory capture, by an alliance between corporations and the government agencies that were supposed to protect us from those corporations. The Amish are not relics clinging to the past, they are living proof that the past actually worked. And every premium check you write to a company that might never pay you back is a quiet reminder of what was taken from the rest of us. If you are the kind of person who has always felt that the systems you were told to trust were designed to protect someone else's bottom line more than your family, then you already understand what this video was really about. It was never just about insurance premiums. It was about who gets to decide how neighbors take care of each other, and who profits when they are prevented from doing so. Here is what I want to know from you. If mutual aid societies still existed the way they did in 1910, covering medical expenses, property loss, and life protection for the equivalent of a few dollars a month, would you choose that system over what you are paying right now? Tell me in the comments, because how you answer that question tells me everything about where this conversation needs to go next. Subscribe so you do not miss what we uncover next week, because the home insurance story is just one thread in a much bigger pattern. And I can tell you from the research I have already done, the deeper we pull on it, the more the whole thing starts to come apart.